How are you?
Just gets right into what's the government doing and why.
Tell me what Mark Carney is.
It's anybody's guess. Yeah, Bill Canada owns, as people in the room probably are aware. They set up a crown corporation to, try to help with some of the housing challenges we have. I think, from my conversations with them in various forums, my understanding is that there are two key focuses. One of them is affordable housing, which it's a challenge for the private sector, right? Because when you're building a project, investing in a project, the affordable housing typology is not really economically viable in just traditional private sector investing. So they're trying to take that off developers' plates, and then they have some other tools that they're trying to collaborate with. If you're asking what I think about it, it wouldn't have been my direction to try to do it myself in government. Like, I would have kind of tried to more enable the private sector. I mean, you got resources, people, capital, infrastructure, like it all exists. So I'm always of the mind that we should try to create the right incentives and have the right capital availability to just spur the private sector into action. They took a different path. I think that they have the right intention, which is to kind of try to solve some problems. Craig and I were talking earlier, at least for once, you have three levels of government that have identified problems, right? And they're not ignoring them, and they're trying to coordinate to try to fix those problems. I think we'll land in a place that makes sense, even if it wasn't the route that I would have taken. But I believe their intentions are great. The new CEO, Anna Milano, was a councillor in Toronto and deputy mayor, so obviously we interacted with her a lot through different files and things that we had done in the past, and she's very capable, very competent, and I think she'll be great. So,
Greg, anything to add to that?
Yeah, I'm more bullish. I think our housing problems are going to be totally solved by this, and housing is going to be cheaper. I mean, I'm way more small scale and less involved in this kind of thing. I'm more exposed to things like the housing catalog that they release, which is a joke. Like, the problem is not architects, it's zoning. Like, the problem is not that we need affordable housing, it's where it goes. Like, it's, to your point, good that we're starting to pay attention to these things, but at the end of the day, it's up to all of us to come up with the different solutions that are going to put us there.
Yeah, and I think that the belief systems that with the affordable housing, that's going to be, like we were talking about, a rosy, beautiful neighborhood. And of course, there's other things around that. Reaching out, Mike, when you're on the streets, showing properties, there are affordable housing neighborhoods, but these aren't typically the neighborhoods that we're going to invest in. What are your thoughts on how that's going to change the inventory, if it's going to change the inventory, and also whether investors are going to be in that area, or is it just going to make investors leave the area? Is it going to turn them into ghettos?
I don't think it's going to happen. And generally, where we're buying with investors is outside of the GTA. So Ben had a great chart up where it showed single-family building permits going back to 1980. So for 45 years, we've been trimming down the single-family building permits. Meanwhile, our population has been going up. There's been a slight pullback, but in 45 years, I think we can all agree our population has grown significantly. So as the investors in this room here, I think our opportunity is on a different scale than Braybrook. It's a land grab as well, and it's on these single-family homes. Because these single-family homes, the stuff like Greg's doing as well, is leading to opportunity and flexibility for us as investors. We can take a single-family home, convert it to 2 units, 3 units, kind of Toronto 6+1, have a garden suite, a Langley house. You're taking one plot of land, and instead of bringing just one income in, you're bringing multiple streams of income in. So I think it's the same thing for us as investors here. The opportunity is the land grab right now, because hard assets are scarce assets. Scarce assets are the best assets. Do we think more single-family homes are going to be built, or less? And the stuff that is being built is predominantly high density, that's not conducive for us to make these conversions. So it's these 1960s, 70s, 80s bungalows, side splits, back splits on the outskirts of the 905s, outside of the 416, unless you're already probably sitting on the property, where I think the biggest opportunity is right now, or at least one of the biggest opportunities is.
So if I can just say something, I agree with everything you said. Part of that, I think, has to come down to policy. And I'll give you guys an example. There may be people here in the room that are part of the project we're doing in Hamilton, in sort of the Alfreda area outside of the city. So it's a perfect example of a development community who's buying a bunch of land, not greenbelt land, but land outside the urban boundary, because the way that cities evolve cannot all be high density housing, right? It cannot be high density housing because the needs of the people who use housing, people sitting in this room and sitting on the stage, are different, right? Some people need space, they have families, they can't live in a condo or don't want to live in a condo. There's preference, there's necessity, all these things. And the city of Hamilton, a couple years back, basically voted to not expand urban boundaries and only have high density housing. So that they didn't say it in those words, but they said no urban boundary expansion, all the growth to meet our objectives, right? And the stated growth plan has to come from the existing urban boundary. Well, that forces you into high density. Like you have no other option, right? And we ended up going to the province, and there's a whole bunch of things that happened to kind of get that decision reversed, and then kind of reversed back with the Greenbelt Bank. I'm not going to go into that, but the point is you had a bunch of policymakers sitting there, in my opinion, knowing full well that you needed to expand urban boundaries to be able to accommodate the type of housing you're talking about, and they just chose not to do it. So if you're sitting in the private sector, you're like, well, if the policymakers are unwilling to make those decisions, then you can't even build low density housing in certain areas.
Part of that factor too is we're sitting in between the world's largest green belt and a body of water. There's not much more developable land to expand if we want to accommodate, more housing.
Unless you know Doug Ford, maybe he'll give you something. And so we were talking about, building up the density, and so Craig, that's where you're finding a niche and what's making sense for you, right? Is the high density.
Yeah, I think what I'm experiencing in the sector I focus in is going to be expanding into all sectors of housing. Basically, when I started my career, you could only build a single family home I'm very Toronto focused, like in 2/3 of Toronto. Then we allowed basement apartments, then we allowed triplexes, then we allowed laneway suites and garden suites, then we allowed fourplexes, now sixplexes, now 6 stories. So suddenly we see in Toronto alone, like all kinds of different typologies from the single family home into the high-rise scale. And we see financing options like CMHC and MLS Select works for a multiplex development now. So it's starting to give us debt solutions for small scale. We don't go to committee of adjustment as much as we used to. Neighbors are out of the way. Like policy and the factors that influence our housing is really changing the missing middle, which is what I focus on. We were just talking about how it's inevitable that that's going to start happening to larger scale developments, whether it be subdivision development or mid-rise and high-rise developments. Like that model is working to create housing in a certain sector. And without question, we're going to see that parlay into different typologies.
And so, obviously, you're not paying the DCs, the development charges, the infill, but with DCs, development charges being up 30% now, Sasha, how are you seeing that affecting your business?
I think it's absurd. Like 30% of the cost of a home is a bunch of costs that can be, I think, managed better. And I understand that municipalities require development charges to fund infrastructure. Like we do a lot of things in the US, they have different financing systems. And Canada has a very rigid, narrow way of looking at things. I think in the US they have municipal bonds, they have all kinds of things to fund the infrastructure, so it doesn't come down to development charges. So the cost that the government will let the burden of government cost in a typical condo project, let's say in South Florida, is like 3%. Compared to 30, right? And so I think that you're hearing now people talk about the federal government, part of Build Canada Housing, and they've said this to me directly, is they're going to put pressure on municipalities vis-a-vis other exchanges to get them to lower their development charges. I think it'll happen for a period of time, right? And I asked this question, we had a meeting yesterday in one of our portfolio reviews, and I asked the question about, I think it was in market or maybe bond, or they had already gone, and so we probably bond, they reduced development charges. But the way they're doing it is like, let's say the development charge was, I don't know, $200 a foot, hypothetically. They're bringing it down to $100 a foot, but only for a period of time. And then eventually it'll go back up to $200 a foot and then be indexed from there. And so I don't know if that can change, but like I think at a very least they're looking at this and recognize that it's a problem and we need to tackle it today. I don't know how permanent it'll be. And I gotta be honest, it was an incredibly frustrating thing through COVID, right? When we had this big bond out there, everybody's sitting here and this revenue went up, 50% in a lot of cases. And it was unsustainable. I don't know if I was here at that time, we talked about it, done so many panels. But at the time, I'm like, this is ridiculous, it's artificial, right? When you have interest rates that are completely zero, and you got people sitting in their living rooms and their savings are accumulating, the stock market's on fire, everything they own in real estate, they can refinance and get more money out of it. What the hell do you think is gonna happen? Why this is relevant is when it was happening, all the cities were like, well, revenue got up 50%, we can jack up development charges 50%. We're like, well, you know what happens? The market piece is unsustainable. You're not going to rewind your development charges. They're just going to sit there. So what you have here, why nobody's building anything, is because revenues have gone down 25%. And development charges stayed at their elevated level because they don't go backwards. And so do the other costs as part of the structure, right? Your infrastructure costs, your labor costs. When you're negotiating labor agreements, right? And new levels of compensation are set, they don't go backwards. So the cost structure is very rigid. And now we're sitting here with a cost structure that's too rigid, and a lot of which is government. And then you don't have the revenue to be able to have viable projects. And as a result, everybody's sitting there, and you're going to have a bigger problem in 4 years when there's literally no housing to accommodate the growth needs of these large cities like Toronto and other global cities.
You seem passionate about this.
Yeah, it's a good point. I was going to bring that up. Where is this now leading? Because it's like Ben was just saying, there's going to be a shortage of housing. Right now, I think it's no secret. I also mentioned that the rents are down right now. Mike, you're probably seeing that rents are down. Is it taking longer to fill a home right now?
In regards to the timeline of how long it takes to fill, we're at a historical average right now, which is about 6 to 10 weeks, which for some investors that were filling 2020, 2021 might seem like a long time, because at that time we'd get a property done within a couple days, multiple offers, people offering over your list price of what you're offering your properties for lease for. Hey, you want a year in advance? I'll give you a year in advance as well. So right now we're back down to the historical average, about 6 to 10 weeks. Rents are down about 4 to 10%, depending on the location of that property and the type of property. But that's 4 to 10% from the peak. That's when rents were climbing up 10, 20% every year. So we're more in line with the historical average on rents as well, taking out all that froth. Which, I'm getting calls recently with investors where they're asking, hey, should I implement the rent increase this year? So it's 2.5% this year, 2.1% next year. And my advice, and what I've done personally, so I'll let you know what I've done personally, is if the house in that unit is below market rent, and good tenant's paying on time, below market rent, I'm saying, then I would do the increase. However, if you just recently filled that property in the last year or two, take it into consideration, rents have come down 4 to 10%, I'd be very, very cautious on implementing that rent increase this year. I'd probably just hold it. I'd send an email to the tenant, text, call them, just saying, I'm gonna hold the rent this year. Thanks for paying on time, all the time, and keep it short and sweet like that. Not, hey, I was at this Rockstar conference and they said rents are going down. Nobody got the can of worms. Just stay short and sweet, not increasing your rent this year, and keep it like that, because rents have come down. It's going to cost you more in the end. If you do increase, they exit, go somewhere else where they're going to get the same property for a little less. Now, you're potentially carrying that property for an extra month or two vacant to have to refill.
And I've seen that with investors too, and worrying about even finding good tenants. So if you have a good tenant in your home and they're paying rent on time, it may not be the year that you increase rent. Maybe you do.
Yeah, sorry. The reality of why it's like this right now is, again, on Ben's charts, we saw the escalation of the purpose-built rentals. Also, those condos that were bought are now, although the pre-construction sales are not happening, a lot of the completions are happening. Owners are taking possession of those condos. Many of them have the full intent to sell them before or once they took possession. Well, they're waiting for a better time now to sell. They're waiting for the market to pick up. So that, the purpose of the rentals and those condos that would have led to a sale are absorbing a lot of the tenants. So that's why that market's a little softer as well. And to add to that, with the pullback on immigration. So just, we're back to a more historical average in regards to pricing and time to fill. But, you gotta imagine this is gonna pick up.
Well, so Craig and I were talking about this, and at a different scale, right? When you're doing these big projects, what you just described is the reason that purpose-built rental cannot be a solution today, right? So the condo market doesn't work. So everybody's like, great, we rental, we need so much rental. But the math doesn't work because of what you just said. The way that you have to finance these things, even though MLI Select exists and CMHC and all these programs, when your rents are going backwards, it changes the whole vector of revenue. If you think about the value of a rental building, what is it, right? Everybody in this room that's in the real estate business should know. It's cap rate, okay? It's an equation. It's essentially the income stream divided by a cap rate. And a cap rate is a rate of return that people would generally expect on these types of assets. Well, as yields have gone up, right? Everybody's seen this through inflation, and they're not coming down because there's long-term inflationary concerns. Cap rates have decompressed. So now instead of having a 4 as a denominator in that equation, you have a 5 or a 4.5. On top of the income stream, the vector of the income stream being also different. Instead of modeling from $4 a foot and going up by 3% a year, it's now at $3.75 and going up, maybe being flat for 3 years and then going up by 2.5% a year. That's a drastic change to the value equation. So when you go to the bank and say, I'm going to build my project and here's how the math works, there's no chance you're getting financing. Unless you're aggressive on your assumptions. So what's happening is people are getting in the ground because they're really buying the future. They're sitting there saying, well, I think rents are going to be a lot higher than they are today, and I think that cap rates are going to compress again. And you can do that, but if you're wrong, you get creamed.
I was going to ask, you both have approaches that are like different scales, but the same fundamentals. Like the people I'm seeing succeed in this environment are being ambitious like you're saying, but also finding ways to outsmart their own typology and, be more attractive than the house next door for rent, like find ways to get additional density or use one less elevator and the same building your neighbor has an extra one. What are you guys seeing that's like the way to be resilient and still do your job in this environment? Starting to take over this question.
I'm curious.
It's the division of those homes that I was talking about on the outskirts that right now, a lot of the investors in this room over the past couple of years, that's what they've been buying because the numbers still work, the numbers still cash flow. So if they're already buying potentially a property that's already been converted from a single family to 2 or more units, or they're buying a property that they don't necessarily have to convert right away, but they have the opportunity to. Those types of properties and numbers are working right now. So I think that's helping in regards to being resilient in this environment, and as well as student rentals. When we're talking about rents that have gone down roughly 4 to 10%, student rentals, unaffected. And I'm going to backtrack on what I just said. When I'm referring to student rentals, I'm talking about what a lot of us in this room have, and that's for universities, McMaster, Western, Guelph. I'm not referring to colleges. That's a completely different animal. But the student rentals for these universities, the room rentals that we're getting are still roughly $1,000 to $1,250 per room. and that's unaffected. Those rents have not come down. We're in October. I spoke to a property management company yesterday, Phil's Student Rentals. We're 8 months away, 7 months away from students signing for May 1st. They are already taking students around to sign leases for properties. That the lease won't commence until May 1st. Leases from May 1st to April 30th. So the demand is still there as well.
Yeah, so again, at a larger scale, similar strategy. Okay, so we have a platform in the US that has rent by the bedroom. So really what all you're trying to do is amenitize the building. So you want to create a value proposition that people look at and see a sense of community. And you know, when they live in a place, it's not just because they live, there's not just nothing to do. There's a value proposition like a gym, you know, not like a tiny little cottage, but like a proper gym and all that kind of thing. So if you spend money on the amenities, people reduce their all-in cost of living, right? So because now they don't have to go spend $150 a month to be at a gym, and they don't have to spend $100 a month to have access to co-working, right? Like you're getting in your building. And then the rent by the bedroom is kind of like the student housing. It's like you're paying for a very small space. All of this is to reduce the chunk rent and or the all-in cost of living, because it's a very cost-sensitive world right now, and that's what you're trying to balance. So you have to be innovative like that. On the flip side, it comes with problems. So if you're in our business, the issue isn't filling the building. If we're filling the building, the issue is that your cap rates are being compressed, and the value of your building is drastically different than when you started. So that comes with a different set of problems. And in these student type housing, and in the world I play in, when you do rent by bedroom, the turnover is much higher, right? And institutional investors don't like that, right? They want to buy buildings that are stabilized. And that means like, you know, like easy maintenance costs, lower maintenance costs. You're not turning over, because every time you turn over, there's costs, right? And in buildings like rent by the bedroom, it's life, you know, like you're in university for a period of time in your life, and you're out, and usually every year. And the same with these rent by the bedroom programs is like people like outgrow it. Like they're there for a year, and then they're like, oh, that's fun. And now, you know, now I have a girlfriend, or now I want a dog, or whatever, and they need more space and they can't do it. So it's a very imperfect environment out there right now. I sound very pessimistic. It will get better, but you know, these are real issues that we have to deal with.
Well, I think you hit the nail on the head with how imperfect it is, and like the solutions we need. Like there are very long-term problems like development charges, zoning approvals, whatever NFI is doing, who I love. But then there's the immediate things we can fix, like alternative revenue models, different ways to rent, different ways to operate your business. Like it seems to me like the people that can still succeed in today's environment are the people that are pushing and expecting the long-term things to change, but also the people that really understand their typology, they understand the building code and zoning and how to operate a leasing model, and they can optimize in everything and really start to think differently with how they operate their buildings. Like that's something that my clients who are still working and still putting shovels in the ground have been able to figure out, but the people who stalled out haven't been able to.
Yeah, I think that's right. It's just harder to do at scale, right? Because like, you know, when you're going to get a $250 million construction loan, they look at the world in a box. And it's like a tick box thing, and it's got to be these things, and it's not very flexible, right? So I think, you know, it's getting better, and you know, I think that you're right. You have to innovate, you have to push, you have to, and I think at a large scale, the people who do this are.
What does that mean for large scale? Like, is it just done until things change, or are there people that can find those niches, like find different ways to make things happen?
Yeah, that's a great question. I do think that there's not enough. I don't want to say done, because there's a lot of variables, right? Like in the cost basis, or like there's a bunch of things, but certainly not going to solve the problem. Like if you look at housing starts, I think the stuff that you're talking about, there's opportunity, right? And people will figure out how to get them help. But like when you add it all up at the end of the quarter, it's not the same as like, you know, 30,000 units that are getting built by, you know, Mattamy and, you know, large scale developers. So it's all to say that there may be solutions at a large scale. It's just until certain rigid things change, you can't unlock massive quantums of construction. And that's why, like a good proportion of my time is spent, like I spend 85% of my time right now with government, like just pushing. And they need to hear it. And people see these open letters that, developers put together, and I don't know that they help, if I'm being honest. Like, you get, hopefully there's nobody sitting in the room, but like, we're part of Bill and the OHVA and all this kind of thing. And they create this like lobby, and they lob a letter in, and they say, we need to reduce development charges, and we need a HST, no HST on all types of housing, and no foreign, or let the foreign buyers back in, blah, blah, blah. And then the government gets that, and they're like, just want handouts to these developers. Right? And I'm like, so that doesn't help. Like, try to engage on a more narrow level to try to solve some problems, and everybody wins, instead of like, lobbying in this like 20-point plan that they're just going to perceive as you needing to bail yourself out. I mean, it's not what it is. You need to do all these things, but there's better ways to try to do it.
Then they're asking the developers why they're not building affordable housing.
I think, Craig, in this environment, we're finding tenants are being more selective simply because there's more inventory out there. Is there a particular design or layout that you're finding is more desirable by these tenants nowadays versus before they were getting into anything? A 350 square foot studio was no problem to fill, but nowadays, what do you find?
Yeah, 1 bedrooms and 2 bedrooms in neighborhood developments like low rise, in like multiplexes, I'm speaking, are the most days on market. Really tiny studio units in a multiplex are going like hotcakes because they're so cheap. They're cheaper than condos. They're the same thing you get in a condo, but because they're built out of wood frame construction, they're just inherently going for less. And then 3-bedroom units, you can't find in a tower. Those are going like crazy. Also, like not just because they don't exist downtown, and they are starting to exist in the neighborhoods, but they're near schools and parks and the things that renters demographic needs. So we're finding that it's like everything outside of the shoebox that we've been building for the last 10 years, we've been building very nimbly in neighborhoods, and those are going like crazy.
So the clients that you work with, they're still excited. Are they, I mean, you might have seen over the years, they're probably changing, I guess, from smaller infill to larger, right? Like the 2 or 3 units to 6, 7, 8 units. Is that what you're finding?
Yeah, I mean, the reason I'm the least depressed person on this stage right now is just because I happen to design and build laneway suites and multiplexes, and those are like the only 2 things that still work. Basically because homeowners are building laneway suites and garden suites, and they just got equity and money, and they just want to put a house in their backyard. It's not really an investment. And then with multiplexes, because they're ahead of the game when it comes to zoning incentives, development charge incentives, financing incentives, they're one of the few typologies that you can get some kind of scale out of. And we're already ahead of the game on all the problems we've been discussing with single family and larger projects.
Yeah, I don't want to give you the impression that I'm depressed. Because it's a tale of 2 cities for me and Grey Road right now, okay? So on the one hand, we own a bunch of stuff. We got to deal with the market conditions and the challenges and the, whatever, and that's part of the job, and we'll do it, and that part's depressing some days. But we'll figure it out. The other side is super exciting. And what I mean is, like, the distress in the market gives us the opportunity to acquire things at prices that I didn't think could ever happen again. Like buying downtown, high-rise land, because it will come back at some point. I assure you, whether it's rental, whether it's condo, there will be higher rise. I'm buying it at $50 a foot. That's like 2005, right? Buying value-add projects like permanent buildings that you convert, where people, especially in the US, have got in over their skis, right? Because what happens is people buy these things. The cost of debt went through the roof, rents have flatlined, and if you're not a big developer and you can't just cap in tens of millions of dollars, you're getting foreclosed on, and you're buying these things for below the debt, right? So I think on the one hand, you deal with some form of repression, and it's depressing, and then on the other hand, you're like, everything we buy now is just gonna crush it. It's like in 2009, right? Imagine you had the foresight after the financial crisis when like Bank of America is trading at 30 cents and JP Morgan's trading at $1 because everybody thought the banks were going under. Well, guess what? It's still in the banks. And 5 years later, you made 20, 30, 50x on a bank stock. Those numbers are made up, but like the returns are massive. And so I think that on the one hand, it's exciting if you can see through the clouds, right? To go out and find things today that you're like, okay, this is going to turn out really well. So it's not an all bad news story in the world of real estate, because everybody sitting in this room should know, and I think does know, it's a long-term business, and you have to think of it that way. And they'll cycle, right? You're going to have your peaks, you'll have your troughs, and when we come out of this, it will. I don't think it will be like a hockey stick, but we'll come out of it in a sustainable fashion, and I think that a lot of money will be made in the next cycle.
And I think it comes down to the wise investors are adapting and growing. Mike, you mentioned student rentals. Are investors still doing single-family duplexes? Are most investors now wanting student rentals? What are you finding?
Yeah, and those are the most sought after. So 2 or more units, whether it's bought existing or that's their intent, and student rentals specifically for the universities are less reliant on international students than the colleges are. So yes, those seem to be where a lot of investors are interested in right now and what is moving.
Are you noticing buying opportunities as well? It sounds like my clients that are buying that typology, like they can negotiate now, they can take their time and like find purchasing opportunities.
Yeah, absolutely. And the buyer can come back on the home inspection and get these little things that before we were in an environment where you were buying with no financing, no inspection. Now it's like, hey, there's a little scratch in that floor. I want that fixed. Sellers will get it fixed. Yeah, and it's just simply because in this environment, because of the inventory, the buyers can be selective. How long that lasts, I don't know. We've had a few rate cuts. The needle has not moved as a result of those rate cuts. But from the mortgage brokers and the bankers that we speak to, a lot of people are getting pre-qualified. They just haven't made that first step.
Well, there's a psychology too, right? People, like, we're all human, right? Like, no, people aren't like all confident today, right? So I think there's an equation of the actual hard affordability. I think that there's confidence and people seeing that the market is kind of caught a bottom and it's stabilized. I think all those things will matter to getting people back. You know, and the question about when does this all happen, I don't think anybody has really a good read as to whether it's 6 months, 12 months, 20 months. But immigration, right? Like, you know, you said, talk about international students and they're not there anymore. Like, and I've been asked a lot about immigration, and it's like, are you worried about immigration? Or do you think immigration is over in Canada? Like, the answer is no. The answer is no, it's not over, and we don't have a choice. We do not have the ability. If you think about the demographic of Canada and the fact that there's more older people than there are younger people, and there are more people retiring than there are people in the working age population, and the, call it, organic birth rate is low compared to the G7, where else are you going to get the horsepower and the working age population to drive your GDP? Now, do we have to reform the way that we thought about immigration? Do we have to regulate the pace? Do we have to think about sectors of the economy where we need to focus? All those things are true, and they're all being thought about. But when we get back on track with immigration, we will start again. And I say this every time I get myself in shit. With due respect to like the Reginas and the Winnipeg, like you're down to a few markets that have job opportunities that people are looking for. With the economy that's shifting, the way it's shifting towards AI and towards technology, and we're trying to embrace that. So cities like Toronto and areas like the Greater Proportion are going to once again become the disproportional beneficiaries of high immigration, not crazy immigration, but high immigration. And then the supply problem that we're all living through right now, because nobody's putting a shovel on the ground, is going to manifest in a way where, you know, you can conclude in this room what that equation looks like from economics 101. No supply, and the tap will turn back on with demand, combined with a more affordable ability to buy, purchasing power, by combination of either interest rates coming down, development charges coming down. It's a sandwich, right? Everything the government does to lower the developer's cost will enable the developer to sell for less money. And every quarter point increase or decrease in interest rates is going to slightly increase the purchasing power of the buyer. And at some point, they're going to meet. Right? And the question will be, how big is that supply gap when they do meet? And that's what happens in price next. So we're all preparing for that. And that's the exciting part. As an investor, and everybody sitting in this room is an investor.
And Mike, so you said that, we were talking about supply and demand with tenants and student rentals. Are investors still finding cash flow, or are you finding that now that the rents are lower, maybe there's an oversupply of condos and the tenants have more options to choose from?
In this environment, an investor should be buying a property that ideally cash flows. Because the reality is, and I'm going to repeat a lot of what Sasha just said, and referring back to Ben's slides, we're at a point where you don't want to be buying an environment where prices are taking off, rents are taking off, interest rates are rock bottom. Because then the opposite can happen, which is today, where we stand. We're at higher rates, where rates should come down. We're at where rents have come down, we're at where properties have come down. When I say come down, they've normalized now. Can we overcorrect and prices come back down further and rents come back down further? Possibly, potentially, but it looks more likely like it should actually be trending the opposite way soon. So if you can get a property today where those numbers look good, theoretically, moving forward, those numbers should only get better. And it's not all those factors have to happen. If it, just a couple of those factors happen, rates come down. We know supply is not coming. So there's going to be a supply crunch. What's that going to lead to? Property prices, rent prices going up. So the answer is yes. Ideally, if the numbers look good today, those numbers should be great in the future. It's just, you gotta wait this out.
And so Craig, where we're at today with the housing prices, land prices, doing the infill make sense? Does it still make sense to do small infill, or is it just a larger infill, or is it all of it making sense right now?
I mean, obviously it depends on your skill set. I have a lot of clients today that are people that have left large development offices to start small development offices, partly out of necessity, partly because there's opportunity. I've always said, like, we didn't just have a missing middle of housing typology, we had a missing middle of like developer, like a missing middle of industry as well, that we're starting to see burgeon. So I have a lot of clients that are really sinking their teeth into multiplexes where they can be more nimble, they can be an Airbnb, and then as soon as that person leaves, they can become a student rental, and then they can go long term. It's a very nimble typology that's a good gap filler for people that have the ability to take advantage of non-asset financing and do some projects. So I think it's vibrant, and what I'm hearing from my clients and starting to see is that they can scale it. Like, people are going from doing 2 projects in the first year to 12 projects next year to trying to buy a property a week. Like, there is an opportunity to turn it on and off as the market allows.
And I think because those properties are so profitable, like when we are looking for the investors, we don't see them come to market. You're sitting on something that's producing very good revenue. I didn't see them.
Yeah, and a couple of years ago, like, my clients were competing against just everyday homeowners that were willing to just spend too much money on a house and say, forget it, like, I don't care. Now no one's doing that, so they actually have some buying opportunities, like they can find deals both on and off market, and that didn't exist previously, so I don't know. It feels like there is a change of winds in terms of neighborhood development that we've never had before.
Where do you see that change then leading in the next year, 2 years, 3 years from now?
I mean, Toronto is already very mature in terms of its housing policy. Like, I can do 7 units on any old residential lot in Toronto, East York, no development charges, no committee adjustment. We're starting to see that permeate into the bigger secondary markets, like Hamilton is diving into missing middle housing, Kitchener-Waterloo. A lot of areas are starting to really follow that lead and incentivize with development charge reduction and easier zoning approvals. I think that's just going to keep to permeate throughout the Greater Golden Horseshoe and Vancouver and everywhere in Canada where it's possible.
First St. Catharines this year, Craig, we had the city giving investors basically up to a $40,000 check per unit they converted as an accessory dwelling. And that was up to $80,000 per property, or $80,000 if you were to do a garden suite. No strings attached. It was a check. It was not a loan. You convert, you get a $40,000 check, potentially an $80,000 check for providing housing. Do you foresee or hear any rumors of any incentives like that coming down the pipeline in any other cities?
Quick answer is no. I think the more popular approach these days is for especially municipal governments to realize that if they just kind of step out of the way, homeowners that aren't building multiplexes get less upset, and developers can actually take advantage of it. So there have been policies like that I've seen come and go, but really the resilient ones are where it's like they change the development charge bylaws or the zoning bylaws to just kind of minimize regulation.
Awesome. Okay, thanks everybody. And